Hello, everyone, and welcome to Ahead of the Curve, a podcast brought to you by Loxy Technology. We're a SaaS platform built specifically for commodity derivative traders. Our mission is to bring transparency, speed, and precision to trading and risk management through technology. And our podcast brings those same principles to industry conversations. Each episode, we bring together leading voices across commodities, finance, and tech to explore where the markets are going and how the most innovative players are staying ahead of the curve. Today, we are joined by Navin Rauniar, who is a senior practitioner and advisor with 20 years of experience across financial institutions, corporates, and professional services. His work sits at the intersection of ESG, regulation, and risk management and spans organisations, including the Tata Group, HSBC, Credit Suisse, and Commercial Bank. He's currently operating in portfolio capacity, but I will not take the spotlight away from him. Navin, it would be great to hear an intro from you.
Thank you so much for the kind introductions, Lauren. And good morning, good afternoon, good evening, wherever you are listening in to this insightful podcast today. So call me Navin Rauniar. If you can't remember my surname, Ryanair will do as well. You know, as they say, it's all about being low cost these days. But anyway, let's continue. So look, I started from a investment banking background in trading and risk management. After the crisis, moved into commodities firms, working at places such as E.ON Energy Trading, Chevron Supply and Trading as well. Went back into investment banking, looking at capital management regulations, especially for the trading desk as well. Ended up in HSBC, where my last stint was basically looking at interest rate risk management for products, including green bonds and green loans as well. And from there, I moved on to Tata, where I basically advised on a number of different sustainability strategies for financials, autos, steel, for example, chemicals, power, and so on and so on. I'm now working, as you mentioned, Lauren, in a non-executive and independent director capacity, working for a number of different companies, advising boards and committees on sustainability strategy, especially in the 2025 reset or redundancy of sustainability, as you could call it as well. Exciting times, Lauren.
Indeed. It's crazy out there at the moment. So again, you've mentioned that you worked across banking, energy, and policy. So how did ESG kind of become a core part of your work? I mean, we've seen a massive reversal, we've seen massive changes. It's a super interesting space to be in. So it'd be really interesting to hear from you, like how you ended up in the space.
A really fair question as well. So, as I alluded to, my last role in industry was with HSBC, looking at interest rate risk management and on products. And one of those products was looking at green bonds and green loans as well. And this was the quiet period, sort of 2017, 2018, at that time when the whole sustainability policies were effectively policed by who? The government. It was the government who was expecting corporates to do the transition, the sustainability transition, the energy transition, whatever you want to call it. So some very intelligent folk in government realized that, hold on a minute, this is not working. So let's put the onus on energy companies and financial companies, because at the end of the day, no credit means no economy. So without credit, you cannot expand your economy. So this is what has happened over, sort of 2020 onwards, especially over the pandemic, is that we all saw the benefits of E and S and G as well, and the plethora of regulation for corporates, for energy companies, for financials, just came all of a sudden. And what has happened, and alluding to your question around how we get into and look at the concept of sustainability, is that there is a whole bunch of terminology under sustainability as well. Now, some people might call it ESG, some people might call it climate transition, some people might call it the clean energy transition. But what I experience, especially working in Tata as well, is that there are different aspects to sustainability, and you need to break those sustainability pieces down into blocks. And if we think about this, under sustainability umbrella, we've got to think about where does it start from? It's ESG and ESG frameworks as well. ESG is your number one block because that is providing your data, your framework, your disclosures, your ratings as well at a counterparty level, at a client level, at a parent level, which whoever you are trading with. But the next thing is that when you take ESG on the left-hand side or right-hand side, depending on where you are seeing this on the screen, is climate risk. And then we expanded into climate risk to think about, okay, how do we think about climate physical risks, which is basically risks coming from climate change, as in precipitation, drought, hurricanes, wildfires, etc., and how they're becoming more, number one, more acute, and number two, more chronic as well. Underneath climate risks, you also need to think about transition risks. And this is the number one salient issue that's facing the industry, because under transition risk, we think about how fast is technology going to expand? How would we look at carbon capture for industries such as the oil and gas industry? How will we look at technology for capping methane flaring, for example? But a lot of these policies are based on either government subsidies or they are based on what the government's policy is on supporting the hard to abate industries such as oil and gas as well. But we need to measure transition risk, technology, government policy, consumer sentiment as well, and how that is going to happen. So that's climate risk all in all. But hey, it's not just ESG and climate risk. You need to then think about that within how do you use that to drive the transition forward. And let's take, for example, the energy transition that is required. So how will, for example, big listed companies like a Chevron, like a BP, like an Exxon, how fast are they going to move from oil and gas to renewable energy, for example? Or how fast are they going to continue to use oil and gas using carbon capture as well? That all requires funding, and that's where sustainable financing comes into it. So we talk about the topics of green bonds and green loans, for example. You can even buy green derivatives to hedge your carbon risk as well. But it just doesn't stop there. You also got to think about carbon markets and how carbon markets basically inputs, especially into the hard to abate industries, because we know oil and gas is not going away overnight. We know steel and aluminium production is not going to go green overnight, especially in emerging markets. We know that airlines cannot decarbonize overnight as well. We're not going to stop flying. We all want to go to a lovely warm location, given the rubbish weather we have in the United Kingdom as well. So how do you use carbon markets in three different forms? So number one, how do you look at carbon markets from a regulated perspective? So when I mean a regulated perspective, for every ton of carbon that is basically being emitted, how much do you have to pay to pollute, and what are the allowances that you have to buy? So, for example, you have the emissions traded scheme that we have in Europe, and we'll talk about that a little bit more further as well. But we also have another market which talks around buying carbon credits that basically allow you to reduce your carbon budget in line with the Paris Agreement. And what do we mean by the Paris Agreement? We mean by reducing carbon emissions in line with and preventing 1.5 degree, keeping temperatures at a 1.5 degree level. And why is that? Because there is a linear relationship between temperature rise and carbon emissions. More carbon emissions, more temperature rise. And then the third part of carbon markets is the voluntary markets as well. Now, this market has been existing for a very, very long time, but it's been highly unregulated. Governments are now coming in to talk around carbon markets, and they're basically saying, how do I basically look at a corporate company whether it's a Microsoft or an Amazon, for all the carbon emissions that are generated from those data centers, which are not using renewable energy, for example, right? How do I go and offset that carbon emission by investing one credit to avoid 1 ton of carbon released in, let's say, cooking stove projects in emerging markets? For example, switching a certain area in an emerging market from, instead of burning coal and wood or charcoal, using LPG, gas, for example, right, which is much more cleaner as well. And what are all the social benefits? But the problem is that the ICVCM, and apologies for all the acronyms, please do Google it, and the VCMI, they're coming together to set standards in the voluntary carbon markets as well. So if we go back to what I was saying, Lauren, how do we bring together number one, ESG, number two, climate, and I forgot to mention nature risks as well. Remember, the impact of climate change impacts biodiversity as well. So climate and nature risks. How do we bring sustainable finance and carbon markets together? We're doing that because we want to get to this net zero trajectory. And that net zero, which is enshrined in law, for example, in the US, in the UK, and in the EU, to 2050. But what's the elephant in the room? The elephant in the room, Lauren, is that we have Middle East with a 2060 net zero target. We have China with a 2060 net zero target, and we have India with a 2070 net zero target as well. So this is the point. If we're talking around, energy companies and who are looking at the sustainability transition, they need to be able to put all of these topics together and think about, how does that fit with my economy that I am operating in as well? How does that benefit the economy from a social perspective as well? What is my governance to basically do that? So this is all interlinked from ESG all the way right down to net zero as well. So going right back to your original question, Lauren, these are the points that I experience, especially working across Tata as well. So Tata are a huge multi-industrial conglomerate, $150 billion of revenue every year. They operate in power markets, for example, as well. So, and their power markets are primarily based in India.
Yeah.
And yes, they're using coal. But the point is that we have to think of this word called just transition. That we cannot just go and switch off coal and like what we've done in the United Kingdom and switch to gas or switch to renewable energy, because the point there is that it requires investment. Number two, it employs a lot of people in jobs as well, and number three, emerging markets, their balance sheets are fiscally constrained. And there is an important part that, when we think about, say, power markets and hard to abate industries in emerging markets, is that where did industrial emissions come from, Lauren? Industrial emissions originally came from the G7, right? So this is what you hear in COP. If you've heard of COP 28, 29, etc. And this is what is continuously being debated, that you want us to do it? Yes, we'll do it, but we need blended financing options. So, for example, we need private capital from the West to be invested into emerging markets, because we cannot shut down our industries. We need to grow our GDP at a minimum 5% every year as well. So that's an example of Tata Power. Tata Steel, for example, in the United Kingdom. One of the pieces of work that I looked at was how do you move from a coking coal blast furnace to using electric arc furnace. That's basically a furnace that's basically powered by electricity. But what's the number one issue? And for our viewers and listeners today, we're all very, very aware that in Europe, the UK and Germany have the highest energy prices in the world, right? And that's because of the way we have our contract for differences basically set up, and we track energy price looking at, for example, the gas price. So this is the issue. So we moved to an electric arc furnace, and that's currently being built. But very interesting to see that electric arc furnace is less labor intensive. So the jobs have to go. So you need to think about what? Transition risk, right? At the
Yeah.
same time, how do you power an electric arc furnace? Do you basically supply the electricity from renewable energy source, or is it a mixture? And this is how you bring your carbon emissions down. But at the same time, can you use new novel techniques such as green hydrogen, blue hydrogen, brown hydrogen as well? And when we think about this new ESG era we're in, where we're talking about what? Energy security, national security, geostrategy as well, we need to produce virgin steel. So the point with electric arc furnace, the furnace that's going to be used by Tata Steel will be used in the UK, will be used for scrap steel, right? So how do we get the virgin steel to be produced for the defense industry, for example, right? But flip it over. In India, they're using coking coal to basically operate the blast furnaces. Is that right or is that wrong? You know, that's up to everyone's got different opinions around the energy transition.
Yeah.
So on one side, you've got a big multi-conglomerate, which is in steel, in autos, in power, for example, and they are looking at a number of different ideas on how does the green transition work. But the point is, from a top level perspective, every economy in every country looks different, right? You
Yeah.
know, so, this is where, interplay of all of those five topics came together. And I'll leave you with two more examples as well from Tata as well. They also opened the UK's first carbon capture utilization plant. So they own British Salt. A byproduct of salt is CO2. So basically, we take the CO2 from the carbon capture unit and we basically resell that down in the supply chain. So, for example, in soft drinks, fizzy drinks, etc. Right? But again, it was the UK's first CCU and it required public subsidy as well. So this is the thing with the energy transition, right? To reduce carbon emissions, this is where sustainable financing takes its play, right? And last one I'll leave you with is EVs. So Tata also owns Jaguar and Land Rover brands
Yeah.
as well. So how do you go and take these 2-3 ton Range Rover Sports or Range Rover SVRs or those big Defenders? You need to basically think about what's the income profile of the person. So if the person has very high disposable income, whether they fill it up with petrol or diesel or whether they charge it at home, that affects them less, right? So then you've got to think about, well, if I'm going to be putting those batteries in the car, what do I need to be doing, right? Well, I need enough battery to pull a 2-3 ton SUV, right? Yeah, And again, I accept listeners might have different opinions on people driving SUVs, right? But at the same time, Jaguar, and they came out with their first electric model, which was launched about 2016, 2017 as well in the UK. But the point is that we need to be thinking about battery capacity and how do we expand the battery capacity, whether it's a small car, whether it's an SUV as well. And just to build that out, the factories have to be repurposed. And these are factories where, guess what? The Spitfire was built, right? And that's how established it is as a brand, but that's how much work there needs to go in. And don't forget who's going to produce the batteries, right? So Tata are building a battery factory as well in Somerset, which again required, different transition risks to be thought about, right? If I build the factory, how do I make sure that, for example, anything around climate change is not going to cause flooding in that area? Because I don't want the factory to go out of production, right? How do I
Yeah.
make sure that the commodities that I'm sourcing as well are ESG compliant as well? And how does that all contribute to a net zero future? And at one point, Tata Steel in the UK contributed to 2% of the UK's carbon budget because of coking coal. So I hope that sort of brings everything together, Lauren, in
No, it
terms of,
absolutely
you
does.
know,
Yeah, absolutely it does. There's so many nuances within the kind of ESG umbrella, as you kind of said. I mean, how do you balance the fair transition with the developing economies, and
Yes.
how do you ensure that even when we're trading, I mean, so many companies in the UK are sourcing
Hmm.
their
Hmm.
commodities and trading materials from those developing nations, and how do you kind of bring them together to ensure that everything is stabilizing and we're following broader ESG regulations. So yeah, that's super interesting to hear kind of your perspective on that. So from your perspective, how has the conversation evolved in commodities, like specifically? I mean, so we've kind of seen people talk about balancing transitions with countries and different policies, but from like a commercial standpoint, how have you seen the conversation evolving within the commodities ecosystem?
Excellent question. So, number one is how fast is the energy transition going to happen, right? So, if I want to basically pivot to renewable energy, should it be 2030, for example, under the UK's current administration, and they want to go for carbon-free electricity, i.e. the Clean Power Plan from the UK? Should it aspire to the EU's Green Deal, where they want to reduce their emissions by X amount, I can't recall the number, by 2040, for example, you know, or should it be, to do the energy transition, should it be a US based type transition where we need to think about, well, shutting down all these industries, especially in the Midwest, such as steel, such as coal, such as oil, aluminium production, etc., you know, is good for us because we've reduced our emissions. But hold on a minute, you've got companies in emerging markets such as China, such as India, and I gave you some great examples as well, where they're using coking coal, right, to do that. So this has all impacted how do we look at the pricing of commodities? And if we think about pricing of WTI and we think about the pricing of Brent, for example, you know, we at one point, the estimates that came from climate change economists who look up at scenarios and the IEA was that, we will basically see oil price basically falling over time as demand wanes off. But that's clearly not the case, right? What we can see is that commodity pricing, and in particular oil, which determines every other price, effectively, the correlation, as we say, is being driven by what? Is being driven by OPEC Plus, is being driven by the US, is being driven by the US being the biggest producer of crude oil as well. Now, the point is, if we want to look at the commodity pricing, if the price falls below a certain level, and there's usually $60 in the per barrel in the market, then it's not economic to go and do, let's say, build a new uh, oil plant, deep sea oil plant, for example, or doing uh, oil sand extraction, for example. So if you look at markets, and as of end May, oil's trading around $60 barrel. So again, does this mean if we hold prices at this level, does that mean that basically long-term production capacity does not increase? But the point is that, oil and coal companies and power companies are saying, well, hold on a minute, right? How fast will renewable energy transition basically happen as well? Now, the flip side of that is that if oil prices go up, then yes, we'll see more production. But to do renewable energy, what do we need, Lauren? We need platinum, we need copper, right? We need
Yeah.
more than that to do what? To build solar panels, for example. We need steel as well to build the wind farms, for example, right? Where is that all going to come from? This is what we are seeing in the intersection of the US. And it's very interesting to see how Mr. Trump is talking about critical minerals. It's a national security issue. well, hold on a minute, critical minerals for what, right? Critical minerals for your existing industries or critical minerals for the future, such as renewable energy? Like if we're going to build those batteries for those 2, 3 ton SUVs, right, that I was mentioning, right?
Yeah.
Where is pricing going to go, right? So this is where the geopolitics and the geostrategy issue is coming in. How fast will that renewable energy or that move to EV or that move to more sustainable materials impact the underlying pricing, right? But we just cannot ignore the price of oil and gas. And we know that because that is what we use to basically make and produce renewable energy,
Yeah.
parts in the supply chain, cars, steel, etc.
I mean, Trump's been pretty instrumental in that kind of $60 per barrel trading price at the moment. I think that was kind of his aim when he came into administration, rather, because obviously it's going to help inflation in the US, but at what cost to this kind of renewable strategy? And also, there's like that whole nuance with the with copper and other transition metals and other green metals, like they're finite resources. How can we speed up the production whilst balancing that energy security? Such an interesting space to be in. Dive into how kind of like what's currently top of mind for you when it comes to that kind of ESG in the energy market. Like
Yes.
I mean, there's obviously the green metals and transition barriers at the moment.
Yes.
What's kind of top of mind aside from those kind of factors?
Yes. So number one is tariffs, of course, right? You can't do a podcast without talking around tariffs, right?
Absolutely.
And number two is we need to be thinking about when we think about ESG, everything we're talking about is reducing carbon emissions, right? If you're going to look at ESG, don't forget the S and the G, the social and governance aspects. What do we need to be thinking about if you are mining for those green metals, as you mentioned, right? Well, what are your social factors that you need to be measuring? And was there a lack of human rights, for example? Was there child labor? Was there mistreatment of workers? What was the industrial rate of accidents that basically took place as well? Now, a lot of this has basically come from OECD principles and principles that have been enshrined in EU legislation as well, Lauren. So if you look at one piece of regulation called the CS Triple D, again, Google it if you want to know what the CS Triple D is or the CS 3D is. It's a directive that basically asks corporate companies to look into their supply chain. And let's take an example, building a battery. Where did you source those commodities from? And was there any of these issues? And please, can you bring them out? And what is your plan? Guess what's happening with this piece of regulation from the CS Triple D? Because of tariffs, the EU is saying, actually, you know what? We'll either pause or we'll drop that piece of regulation, or we'll make it more finite. That's because the US are saying, hey, well, we want to invest, but why have you put in more of these regulations? The other point to think about is that geopolitics is that Global South and the G7 is becoming increasingly polarized now. So the Global South are feeling that, well, we're feeling the impact of economic growth, but do not tell us what to do. We will sort out our issues ourselves, right? And at the same time, the Global South and the US are also saying that, well, this is like a tariff for us. If you're saying that in ESG, you're asking a small company operating in the countryside of China or India to basically declare all of this, well, you know what? How can we do business, right? The other point as well is there's another piece of regulation called the EU's ETS and the EU CBAM as well. So CBAM is Carbon Border Adjustment Mechanism. So every time you bring in, let's say, those green metals, for example, or let's say you build a battery using those green metals, when you import into the EU at the border, you've got to declare what were the emissions, what were the carbon emissions, and if those carbon emissions are high, you need to buy certificates from the ETS, basically. Why? Because they want Europe to go green and in industry to go green, but it's not fair if somebody's basically got a price advantage because their carbon emissions are higher.
Yeah.
Again, that is a source of tension as a non-tariff barrier for Mr. Trump and his administration as well. So you've got US companies which are saying, well, hold on a minute, I'm buying aluminium and steel, and that's coming into the US, but I'm basically being charged the cost which incorporates, the carbon emission cost or the ETS cost, for example, or vice versa. America is selling back to Europe and they're being charged the CBAM, the carbon tax, basically. And it doesn't just extend there, it extends to the UK as well. The UK has plans for a carbon tax on steel as well. Now, again, how is the US going to view that, right? Non-tariff barrier as well. So all you're doing is you're driving up the cost of commodities, inflation, or in particular greenflation, you could call this. That is why, under I think it's Section 252 from the US administration, you've got 25% tariffs on aluminium and steel coming into the US right now. Now, this is where the Trump administration is basically trying to influence where is the price in commodities going to go as well. And when they think about national security, we need these metals for what? Semiconductors, to build semiconductors. So how do we do that as well? So everything, any type of tax, any type of legislation from a green perspective, and again, viewers might and listeners might have different opinions, it can be seen as driving the price of one unit of the goods up, basically. So how do we balance all of this regulation with the global turmoil of tariffs, with conflicts that are going on around the world as well? How do we make sure that we can make a more fairer green CBAM, maybe, right? And by the way, the India, China, they've taken this concept of CBAM to the WTO as well, World
Oh,
Trade Organization.
okay. Have you got kind of any insights on that? That would be quite interesting to hear. Have they kind of drawn up something between them and the BRICS? I've not
Yes.
actually
So
heard of this.
yes. So the BRICS have a huge opposition to this as well. Uh, Latest on this is that the WTO are saying that, well, it's not it's not it's not effectively breaching any agreement, but emerging markets, the BRICS are saying, well, actually, we view this as a tariff, and if you want to put that in, then we need to rewrite WTO terms as well, because we cannot expect economies, including the US as well, just to slap tariffs on us, whether it's a Donald Trump tariff, right? Or whether it's a green tariff, for example, as well. But the debate is still continuing, and arbitration is happening in the WTO at the moment.
Well, yeah, no, it kind of brings back into that kind of original argument, right, of how our economies and the global commodity markets are supposed to expand with
Yes,
that, and economy-wise, like how are they supposed to grow? And with that kind of nuanced argument of, well, how can they trade with people? So it's super interesting. So like, there's more globalization than ever, but we're more polarized than ever. I genuinely feel that. So kind of going back into that point.
mm,
So where, like, in kind of the West, where are you kind of seeing climate risks most directly impact kind of commodity portfolios? Like, so you mentioned steel, you've mentioned, are you seeing that kind of anywhere else where it's super interesting from like a
yes.
commercial standpoint?
So let's think about, go back to day one. We know climate change is worsening, right? But where do we see the impact of climate change, right? Yes, we see it globally, but it's more pronounced in emerging markets, for example. In emerging markets, they don't have the infrastructure, B, they don't have enough funds to respond as quick, and number three, then they still need to keep the economy running. So when we think about, let's say, a gold mine or a copper mine, whether it's in South America, whether it's in Africa, whether it's in emerging markets in Asia as well, when it rains, like a monsoon, it's becoming more and more extreme, especially in Asia. When we look at Africa, precipitation is going down, but drought is basically going up. And this is all proven by the IPCC, which have done a very, very good job on rationalizing the climate data. So when we look at the hit to GDP or the hit to the economy, well, that mine could be flooded overnight, for example, or if it was heat and extreme heat because of and drought, how do you look at the impact on workers? How do workers, can they continue to work in extreme heat, right? And and it goes back to my principle of ESG sits at the top level. You got to measure that. You got to measure that, right? And what does that mean? So climate change doesn't just impact in the sense of, oh, there's a flood and the factory shuts down. It can impact in various different ways. The other point is if you're a multinational company and you've got factories all around the world and you're dependent on each other because of the supply chain as well. Well, if one factory goes down or offline for say 2 weeks, 3 weeks, 4 weeks because of extreme climate risk, and how do we measure this? Physical risk and physical risk scores, but I won't go there or we will be here all day. Your capital, your capital expenditure, remember you would have invested a certain amount to build that factory, effectively, how are you going to get that return back on your capital expenditure? Two things happen. Your operating expenditure spikes for, let's say, 2 weeks or 3 weeks, whatever the period is of the factory being or the mine being out of service. And the other thing that changes as well is what? Your revenue, right? Your revenue falls. You take a hit, basically. So it's a double conundrum coming from climate change. And this is what we need to be modeling in the cash flow. So we need to basically be trying to understand over the next 5 years, what are the types of climate risks, but at a geospatial level. We need to understand what is a climate risk where the oil rig is, for example. Will there be more extreme storms in the North Sea, for example, right? And let's not forget America, regardless of the Trump rhetoric, right?
How can you forget that?
Again, these conversations I have to include Mr. Trump, right? A great example is a couple of years back in Texas. Texas, biggest oil and gas producer, but also the biggest green provider as well in solar and wind.
I did not know that. I knew about the oil and gas, but wasn't sure about the.
So hugely invested in the green transition as well. But guess what happened? It's usually nice and hot and sunny in Houston, the oil capital of the US, and I do remember that from 15 years ago when I lived there. Guess what happened? Because of climate change, they had a very extreme winter, and it's very, very rare to have an extreme winter there. So because a climate risk assessment was not done on the wind farms, for example, the wind turbines froze up because of the extreme cold weather. And guess what? That power contributed to grid capacity as well. And what happened was you had utility companies, because they used dynamic pricing, location-based pricing in Texas, the spark spread basically went through the roof. Electricity prices basically went through the roof as well. You also saw some of the refineries being closed down as well. So yes, you hear about hurricanes all the time, for example. That's climate risk as well. But extreme events tend to be happening more often. So you see, there's an example from a G7 country, but the same thing happens in emerging markets as well. It's just that resiliency, and that's why we talk around how do I use climate risk against my commodities portfolio, and where are these commodities going to be used, and how is the pricing, supply and demand going to change if there is one of these prolonged acute climate risk events or a one-off extreme climate event as well. And don't forget transition risk, right? You need to, how climate resilient are you? Have you done climate adaptation? Have you adapted the refinery to be hurricane proof, for example, as well? Or in Texas's case, have you now adapted the wind farm so they can turn when there's extreme cold weather, right?
Yeah, no, it's such an interesting kind of standpoint to be in. I mean, these events are happening far too regularly to be ignored. So it's
Yes.
great that you brought that up. So kind of like last two questions from me.
Hmm.
Where do you think, or like, what kind of role do the investors, exchanges, and kind of fintech providers play in enabling this kind of like transparency and strategy and alignment? I mean, we kind of talked about it from an upper and a broader level,
Yes.
from a like a government level. Like when we kind of operate down here and we operate as feeders of the economy, where do you kind of see fintechs and investors and exchanges kind of playing in that strategy long term?
So a very important part, you know, uh, and let's start with first principles, pricing, right? So how do we build more liquidity in markets? So existing markets, oil, corn, wheat, platinum, etc., right? There's very good liquidity there, right? But how do we build more liquidity in markets such as carbon markets? So if we look at the UK ETS, which was trading at £30 a ton of carbon basically emitted, but it's actually just jumped another £10. Why? Because because of Brexit, and we always have to mention Brexit, right? Because of Brexit, we used to have a European scheme. Now we've basically got a ETS scheme, emissions traded scheme, i.e., carbon compliant markets for certain industries, pay to pollute. So the more carbon you emit, the more more allowances you have to basically buy. That is now trading at £50. The EU scheme, about 60 to 70 euro range as well. But we need more liquidity, and we need to build more products in that area as well. As the energy transition progresses, as we understand the impact of, say, climate risk on commodities as well, we will realize that, okay, do I need to have a carbon market strategy? Do I need to measure my carbon delta coming from my commodities delta that I measure in risk management? And we already have ICE, which have launched futures on carbon markets as well, in the regulated markets, i.e., the ETS as well. We need more liquidity in other countries. For example, in Korea, in China, the US even has a carbon trading scheme, but at a state level. Canada has one as well. The point is the deviation in pricing is there's huge spreads between each carbon price. So what we need to move is introduce that liquidity and build a global carbon market, which will give us a global carbon price. That we are really way out from doing that. The next part is the voluntary carbon markets, where say corporates and can basically go in and reduce their carbon budget by doing offsetting. Platts, who typical provider in commodities market, they're doing a really, really good job in looking at different voluntary carbon market pricing. So nature-based credits, for example, energy-based credits, for example, as well, biodiversity based credits as well. Again, we need more liquidity there. We need more transparency in pricing as well. So we need to basically start replicating what we've done in commodities markets, in classic traditional commodity markets, to carbon markets, may I say. The other point we also need to be thinking about is if you had an ETRM system or you had a risk management system as well, fintechs have a great opportunity to basically think about, okay, how do I basically do scenario analysis on the pricing? Because everything is about hedging. You need to be hedging your risk management, your COMO one, basically your commodities delta. If you're going to be hedging that, how do you do climate scenario analysis and how do you build that in to your trading and risk management system? How do you basically look at, let's look at non-energy commodity wheat, for example. So if climate change at a geospatial level, at a local area, is basically saying that we forecast a drought in a wheat producing area, anywhere, be it the US, be it Ukraine, be it wherever, right? Yeah, how is that going to impact global wheat price, for example? You know, what are the scenarios that need to be built to model the pricing? But at the same time, we can't forget that geopolitics, national security, energy security, right? How does that all overlap? So every underlying uh, commodities product you are trading is going to have a slightly different sustainability profile. But don't forget the correlation, right? Correlation is very, very key, and fintechs are going to play a very, very important role in that area as well.
Fantastic, thank you. Yeah, I completely agree. Not because we're from a fintech, but just because I think fintechs are massive enablers of, this
Yes.
massive like transition period that we're going through at the moment.
No,
So
of course. I'll leave you with a humorous example as a last one. Look at the cattle price, for example, on the CME exchange. Trades at about things around $200 a pound, basically, right? Yeah, pound, not kilos, right? Yeah, on the CME. When you think about cattle, did you know that I think it's about, don't quote me on this, but it's around, out of our greenhouse gas emissions, it's not just CO2, it's CH4 as well, methane we need to be thinking about, right? So we're actually, financiers are looking at, hold on a minute, you're a farmer and you're trading your cattle. How are you going to reduce the belching of methane from their stomach, from the front and from behind, but I won't go there right here, to reduce methane emissions? So does that mean you produce less cattle? Or
yeah.
do you require technology, right? So how do you model the price of cattle, given that we're trying to, and also the socio perspective? Oh, we're all becoming vegetarian. I'm not vegetarian, by the way, right? I love my meat. Yeah, it can be anything.
Me too.
Uh, the point is where, if we're eating less meat, what does that mean for the cattle price? What does that?
Yeah.
So there are so many different areas where fintechs can basically look at it. And I thought I'd bring up cattle and wheat because, it's not just commodities. We tend to think commodities, energy transition, carbon emissions need to be reduced. It's all types of greenhouse gas emissions.
Yeah, I know. I like agriculture contributes to about 30% of all greenhouse gas emissions, or
Yes,
something
it's
like around that ballpark
something
figure.
around that number. Yes.
It's crazy. I think there's so many. I mean, agricultural commodities within that space. I mean, we have to look at everything. We have to look at every nuance, really, and
Yes.
there are so many opportunities within that.
Yes. So
So
the farmers can go and tell the oil and gas companies, hey, reduce your methane flaring, right? And then
yeah,
oil and gas companies can say, hold on a minute, yeah, reduce the belching, I'm trying to put it politely, from your cattle.
to put it politely. And then finally, Navin, what's your kind of single piece of advice to commodity trading firms and those massive players in commodities trying to get ahead of the ESG curve at the moment?
Yes. So I'd say number one piece of advice, it's called sustainability. The best word to use especially in this polarized political environment that we are in 2025, is to say sustainability. The conversation starts there. ESG, unfortunately, as a word, has been weaponized by the US as well, But principles are number one piece of advice: start with sustainability and break it down into those pillars, as I mentioned. ESG, climate, nature risk, sustainable financing, carbon markets, and how do I get to net zero? What are the data analytics and reporting that I basically need to do if I am trading a portfolio of commodities? What are they impacted individually from an ESG, from a climate and a nature risk perspective as well? Don't use today's rhetoric. We all know there's a climate crisis, right? We all know that we need to go to green, and that was happening, and we had good momentum. Modeling is very, very key here as well. I think I alluded to that as well. How do we model where the price of gold or silver or platinum or cattle or wheat or corn is basically going to be? Not because of climate change, because of sustainability, the transition, right? And how do we basically look at that? And if you can back that up theoretically, and if you can get that right, and modelers are wrong as well, right? If you can get that right, that gives you justification to say that these are the changes that are required in our strategy. But we have different plausible outcomes in our scenarios, right? So you just can't say, hey, carbon emissions are going to fall like that, or methane is going to fall like that. There might be a blip, there might be a change, there might be a global event, for example. Modeling is very, very key, very challenging, but it really gives a lot of options to the board to understand, okay, where do we go and where do we pick our transition and what is sensible?
Okay, fantastic. Well, thank you so much for that, Navin.
My
And
pleasure.
thank you for joining us today. This has been absolutely packed with insights. So I'm sure anyone listening will be very glad to hear all the nuances and where the conversation went. I think this was really, really, really interesting from my perspective. And I'm very glad that you've joined us. So thank you so much.
Hopefully we can repeat this again, Lauren, as well, and maybe some of my predictions might be wrong, some of my analysis might be incorrect, right? So let's see. But look forward to doing another one with yourself, Lauren, in the future.
Let's circle back, absolutely, and see kind of where things have gone for sure. Thank you so much. Yes, this is great.